Hey traders, welcome to Charts and Coffee. Hope everyone is having a good Tuesday morning. All right, first things first, we've been talking quite a few days now, probably since Thursday, Friday of last week. And then we talked about on the Friday free video that this is the move that changes everything. And this move was the move that on the 11th finally got us out of what was a multi-week compressed this channel action that the S&P was stuck in. Remember, the S&P is an interesting barometer of both the NASDAQ and the Dow because it's weighted with a little bit of the important sectors from both. So not that the S&P is the most important, it's just the best sort of barometer. And by breaking out of that range at 58.30 and seeing the follow through that we got on Monday, yesterday, the 14th, am I surprised that we're stalling out a little bit here? Look, nothing has to go straight up. In fact, when we first pierced this level on the 9th, the next day was an inside candle. And I think for a lot of traders who are momentum oriented, and there's nothing wrong with it, just know the pros and cons of each style. If you're momentum oriented, meaning a higher high gets you in, remember, you've got to have a certain amount of tolerance for a stall or even a slight pullback where traders like me are looking to buy, say, the area around 58.53. So that would be where the volatility or the daily price movement range is sitting. And if I can get down to that sport, I'm going to buy. We're both looking long, right? In an uptrend, momentum traders are looking long. Exhaustion traders or buy the dip traders are looking long. It's just a matter of where are you getting long from and how are you controlling the risk from the entry that you've taken. And ultimately, that's where the styles are going to have the biggest differentiation. How you get in and how you manage risk. Both are long, but that's something to think about before you embrace either style or decide to deploy either one. But this is significant, and it continues to be really very important to see price remain above what was once resistance, now becomes support. So yes, I would think this is a successful breakout as long as we stay above 58.30. Let's take a look at the economic calendar, because what could be those, there we go, what could be those, here we go, Tuesday. All right, what could be those things that could trigger more upside, trigger more hesitation, trigger a pullback? We don't have a lot by way of data this week, but what we don't lack, my gosh, is the constant barrage of the FOMC events. Daly and Kugler today, going into Wednesday. Pretty quiet Wednesday, if I recall, import prices. Yeah, Wednesday is pretty quiet in terms of data. It's not unusual to see if on a week that just Fed members dominate the conversation. There's no meeting in October, by the way, so there's going to be no blackout in terms of that period of time where the Fed members stop speaking with some proximity to the meeting. There's no meeting. So who knows what they're going to do this week. We do have the ECB this week as far as major central banks speaking. And that's going to put mostly the dollar and treasuries, perhaps gold, in play with that on Thursday. But notice today, not a lot by way of data. Empire State already came out, and that response was choppy at best, a resumption of the overall bullish chop that we've been seeing in the ES and NQ. Another thing to mention, we saw this sporadically through summer, and this is not a problem, but it's something to be aware of. And that is that the NASDAQ and the Dow seem to be on this you zig, I zag trajectory. NASDAQ is punching up to higher highs in the morning while the Dow is slipping down the backside of the mountain. I mean, look at this. Whoops. I kind of almost see Homer Simpson. Doe. Yeah, those are the things that go through my mind. If we're taking a look at what's happening with the ES, which is going to be caught in the middle, if the NAS is strong and the Dow is weak, that is not necessarily a really good day for S&P trading, because it's going to be under this constant push-pull of the tech sectors that are weighted within the S&P, and of course that are the NASDAQ pulling it higher, while the financials and the healthcare and the energy sectors are pulling down on the S&P, and it's got weighting there as well. So these are the things that you want to keep in in mind on those days. You might be thinking, what's going on with the SPY? What's going on with the SPX? Your best days are going to be when the S&P picks one or the other. So either financials and healthcare are organized and moving together, which lets the S&P move like the Dow, or technology is just that influential that day and the Dow's kind of flat and the S&P can move with it. Be careful on a day like today because of that tug of war. Unless either the Nas joins the Dow or the Dow joins the Nas, however it might be. I mean, it's so early, right? Okay, so as always, gang, if we are looking at the Dow, that's what I'm talking about there. And by the way, the Russell is following suit. And it's not unusual. And some of my best Russell and or Dow trading days are when those two are moving together. That's another thing to keep in mind. Large cap and small cap, you might think, well, what do they have in common in terms of holdings? Nothing. However, in terms of sector weighting, the regional banks and the big banks are the most dominant sectors. So regional for the Russell and big banks for the Dow. Speaking of big banks, Yahtzee. Oh my gosh, earnings season is here already. And anyone who knows me knows I detest this time of year. We have to tolerate it 4 times a year. It's become a spectacle, unnecessarily so. These are not trading opportunities. They are volatility events, and they are not the same thing. For me, the ramp up into earnings, the preparation, the discounting for earnings are some of the better, cleaner price actions, which is to say, it's really a type of swing trade with a final date in mind where we know this earnings release is coming out and I want to be flat. The other part to think about with earnings is it's a very binary, high implied volatility type day. And obviously going into those final days, implied volatility continues to ramp up, which is another reason why getting in and chasing momentum into earnings is absolutely a disaster, because if you're chasing, let's say the JP Morgan or Bank of America has earnings, Citi has earnings, Goldman has earnings. The bet that you're making, and it's a tricky one, the bet that you're making chasing higher buying calls, say into bullish momentum before earnings, is that the implied volatility is so high that there's got to be a significantly higher move after to keep that volatility implosion that oftentimes happens when the event has happened, this sort of sigh of relief. It's the difference between, I'm going to date myself here, buying a Cabbage Patch Kid doll when mothers were UFC beating each other up over these ugly dolls. My sister wanted one, I remember, these homely looking things. And literally, I mean, UFC style battles happening over these dolls. And on the 24th, these are $2,000 dolls or whatever the craziness was. On the 26th, 27th, not so much. So keep in mind, there's that, that Cabbage Patch Christmas. I don't care. Put in the PlayStation. I remember that too. There's that effect where based on that timing, there's going to be a different psychology. 24th and 26th, hardly the same month, is it? When you're talking about Christmas and December, in terms of the value of certain things being under the tree. That's the psychology around earnings. All right. So let's tackle some questions here. I'm keeping an eye on all right, here we go. Chris asks, volume used to be more prominent on my chart setup. Is volume still part of your consideration? It still is. Chris, I'm not sure what volume tool you're asking about. I'm using a pretty streamlined layout just for the sake of simplicity for folks to follow along. But there's a couple of things that have happened, Chris, and thanks for asking. If you're looking at my trading view charts, yeah, I still have the visible range volume profile there. We have VWAPs on there. I've never used a volume histogram, so I'm not sure which volume tool, but I've never used a volume histogram. Those are next to useless. In other words, those histograms that run horizontally across a chart that show how much volume happened on a particular day or time, I've really never used that with a lot of emphasis throughout my career, and I just let it go about 10 years ago, easy. The price based volume, right? Visible range volume profile, anchored VWAP. It's got to be anchored, by the way. And it's not a randomly anchored thing. There's a process, but an anchored VWAP, the V score, value area highs and lows, points of control. What else? And by the way, when we reintroduced my core indicators, which were the TOPS indicators, grab, wave, propulsion, Darvis, and have the evolution really and the complete rebuild of those tools. Part of what's built in is that participation. So it's definitely there. Yeah, as far as V-score goes, yeah, Chris, you want it here? I'll show you. This is another screen on I've got 9 screens, right? This is not the only screen I'm running. I've got 9 screens here on the rig. This is my other screen. Chris, there you go. I've got the VWAP in there, my anchored VWAP. We've got the Trendolorian on there. We've got the V-score. So I just try not to overwhelm visually members in the room with everything, because some charts get to be absolutely bonkers. And I'm trying to keep it streamlined to a way where traders can say, okay, Rag, I see the color of the candles. I see the structure. I see the support, the resistance. And then depending on what other tools you've got from me, you've got the latitude to add those on as you're visually comfortable adding them. And I think the most important thing about adding new tools to any layout is that you have a base that says this is the structure, meaning momentum and trend. Whether that be the multi-structure, I like to then add in the top tier candles, because then I get 2 different views of something very important, which is, are we bullish or bearish or neutral? And how long have we been that way? And I think it's not just the right edge. I think a lot of traders get caught up on the right edge of the chart. Today's candle, yesterday's candle, when in reality, seeing the history of the behavior is also really insightful. Hence, multi-structure and the candles are super helpful. Automatically draw support and resistance. There's your Darvis. Find those minor highs or minor lows. That's also part of the Darvis 3.0, by the way. And, then I've got my top tier wave. Now, there's other things I could add to this. There we go. I've got other things I could add to this in terms of the V-score, more anchored VWAPs, the secret squiggle, which is my overbought, oversold tool. There's a lot of things we could add to this, but not necessarily something we need to start with, right? I don't need everything on the screen to start with. So thank you for the question, Chris. I get that from time to time. And believe me, if I've introduced a tool, it is 100% on one of my 9 screens. I don't know if you can all see this, but one of these days I'll turn the camera around so y'all can see what I'm sitting in front of. So, all right. Next up, John asks, thoughts on telephone? Sure. XLC has been a really strong part of the NASDAQ. XLC overlaps with the IYZ, which is the telecommunications. And, it's been such a great part of the XLC strength. XLC has not been, for the most part, led by Meta and Google. Really, maybe Meta, because that's about as good as one of the Magnificent Seven are looking right now. But what's really interesting is how the communications overlap has put things like TMUS, T, like your question, John, VZ into focus. There's 2 things I would do with T. First is, right, and where is my drawing tool here? Okay, here we go. First thing I would do is just study what we just talked about. What's been the general gist of this thing? It's been up. And this is where I tell traders, listen to me now, believe me later. The probability of a stall being a reversal is far lower probability. We all have a probabilistic mindset. Continuation is far more the probability when we go into uptrend, chop. So continuation. And that's pertinent to where we are right now on the chart. So if you're in the room with me, John, this is how we'd set it up. First, we got to find, an at the money or slightly in the money strike. Acknowledge that this is no longer a trend or trying to wobble out. What other levels do we have that'll help us with the timing of the entry of that at the money call or slightly in the money? We'll have to look at open interest. And then, yeah, that would be something to keep an eye on. Also acknowledging that this weakness might be a little bit related to dividends. You can see right there. Yeah, I like this one. I do like this one a lot. I would definitely want to think about that as a swing buy. Now, does it have to be on the daily? Yeah, I think the daily would be the best way to do it, as opposed to maybe the 1 hour chart. All right, how are we on time? Okay, we still have a few more minutes. So, Chris, thank you for the question. John, thank you for the question. KP from our Simpler Essentials room says, now I will always see Homer on a down. You've seen that. Y'all have seen that video, right? Where Homer's just boom, boom, boom down a hill or some mountain or something. Poor Homer. Yeah, I can't believe that. That show's still on the air, right? The Simpsons? I haven't watched it in a very long time. Yeah, amazing. Amazing. But yeah, I always see Homer. Dope, dope. And I think the funniest thing about downtrends now is just this obsession with when the crash is going to be, where the top is. I will tell you, where is the top? When are we going to have a 10, 20% correction? I'm trying to think of what other pedestrian thoughts about top picking are out there. That never factors into a trade. If I'm sitting at a high like we are right now in the S&P, this is really simple. I'm not going to buy here. I don't hate my money, right? I'll find something that's in an uptrend. I'll find something that doesn't have earnings breathing down its neck, and we'll get long based on the structure of the trade when it dips. And, this is something I talked about quite a bit with the members yesterday in the sector secrets. Overextended. Yeah, that's another one. Overextended, overbought. Yeah. Remember that trends are always going to be perpetually looking overbought, right? It's an imbalance of support and resistance. It's an imbalance of supply and demand. What we want to find are things that don't have earnings breathing down their neck. So that's about 2 weeks, and has a trend. We wait for a dip. And this is the idea. This is a great idea to wrap the show up on. If you're buying anything in the real life that we live, Wall Street, trading, that is not the real world. It is not real life. But if you're doing that and something you want that you perceive as being valuable to you went on sale, would you buy it? Probably. Prime Day counts on that twice a year and not even that valuable. Sales work. We're coming up into Black Friday. Sales work. But there's a list of things in our mind that we do want. When those things go on sale, we buy them. In Wall Street, not only do people not buy a sale, they perceive it as diminishing the value of the very thing they would have wanted at the higher price. And worse, they'll return it at the lower price. That's where the psychology of Wall Street and normal human nature just diverge. And it's really a funny thing to watch, because in terms of a person is smart. I remember hearing this a long time ago. A person is smart, but people are dumb. Be careful watching people, the masses, behave to the broader averages. They're almost always wrong. The institutions rely on this, just like Vegas does, right? When people want to make Vegas and Wall Street analogies, there you go. It's the behavior of the gamblers, the behavior of your average uneducated retail trader and retail investor, and the way the institutions perceive their typical behavior, which is pretty predictable. Oh my gosh, the markets are crashing. Sell everything. Not there's a lightning deal on Amazon, and I wanted this thing. Let me buy it, right? Remember that. Don't get caught up. It's hilarious that it happens. Just be aware of it. Use it to your advantage. All right, gang. And I don't see, again, with more participation across more sectors. If you're a reader of the top tier Outlook newsletter, check it out. If you're not, come check out what we're doing in the Sector Secrets Mastery. You get access to that as well. You'll notice where we are looking and what we're seeing is broader participation. That's not bearish, gang. Pullbacks happen, but they don't have to be crashes. Let me wrap it up there, gang. I will see you all tomorrow, same time, same station. Be good to each other.